Good morning, everybody. Cowboy here. It is Tuesday, 8:30 a.m. EST, coming off the 3-day weekend, and we're going to jump right into it. AlgoFactory.tech. Check out the QR code, top right-hand corner of the screen, or go to AlgoFactory.tech to find out what we do. We help people become traders. We help people learn how to trade and build their own trading method. Okay, so 8 o'clock a.m., that's 10 o'clock a.m. EST, we have some manufacturing data coming out, and that data might push prices around a little bit, especially in the Forex markets. But if this data is different than the estimate, right, there's the forecast number here on the right. And if the actual data is far off from that, then we might see markets take quite a move. So let's go ahead and take a quick look here at Bitcoin and see how the coin is doing. Been pretty active the last 24 hours or so, a bit short-term bullish. And many think that it might be heading up here, and I could see a case for that. Look, if you look at the high time frame, and I mean the high time frame, the volatility is really fallen off a cliff. So you have, this is the monthly, by the way. So you're looking at a chart going back to a year ago. And this last 6 months, whatever it is, go back to March, you'll notice the price is just kind of chopping, and it is a little bit of a downtrend, lower highs, lower lows. And we just had a nasty rejection up here towards the end of August, right at 64,000. Price tried to rally up, and it came back down. Now, is it going to continue down lower? This is where we get to see whether or not this little downtrend continues. And I could tell you in a high time frame, this actually looks like a bit of a bull flag. Now, on the low time frame with Bitcoin, I do not really look at or pay attention to or try to trade bull flags, because Bitcoin has some algos, very nasty algos, and it likes to print fake bull flags, right? But this right here on a higher time frame is, well, let's just say less distrustable. Okay, it's a little more trustable of a bull flag. That panic move down, that's one that I'm kind of careful about, because we had the Japanese yen and that whole situation. There's always that. But if we kind of look at that as an outlier, this is actually pretty safely a bull flag. So how do these act, right? How do they pull out? Well, what we do is we take a look at the flagpole. And this flagpole, this is old school. This is like OG trading, kind of a newbie way to do things. But if you look at an impulse upward, right? Just a straight impulse upward, and you copy that impulse. So like, for example, what's an impulse? An impulse is when price moves in one direction without really pulling back very far. So this pullback broke this first impulse, and then we had the second impulse up, and there wasn't much of a pullback on the way up on that second impulse. So if we copy that leg and we paste it to the bottom of the flag, wherever the most recent bottom is, which is basically right here, then the target to the upside is 88. Now, of course, there's always leeway. And again, normally I would actually be concerned about this move down. But remember, that was a fundamental cluster F right there that had to do with the Japanese yen. So maybe I can, more take a look at the trend rather than take a look at the actual, number there, right? So kind of an estimate, bit of a rough estimate as to where things might go. Another way to do this would be with Fibonacci extensions, and that's going to be able to have us ignore the problem here of this Japanese yen move down, and our target would be at about 84,000, 84 and a half, and then we have 96,000 according to that, right? We could also actually take a look at a broader move up on a higher time frame. This is not going to show a pullback. So this is our move from October of last year up to here. So this is a very, very macro move. And we can take a look at that macro impulse. And your target is going to be, again, about 87,000. So it looks like 87, 88,000 is an important number. And then your next move up from there is going to be 103,000. I probably would be paying a little bit stricter attention to 100,000 on that, because that's a very, very important psychological number. Price has never been that high, and that's a nice round number. So, I would look as price breaks out at those two numbers, about 88,000, maybe 87 and a half. and then about 100,000. Those are the numbers I'd have my eye on. So that's a very macro look, right? Where might price go after that? Now you're starting to get into some pretty high, very, very macro territory. You're looking at different market moves. You're looking at dynamic changes. I don't even worry about it. I know there's a lot of estimates that look really good using a lot of high level math. That is just not math I've ever studied. Not to say it's beyond me. It's just I'm not that high level of a mathematician. And you're looking at anywhere from 160 to 220,000. Seeing some really, really good work aiming at numbers that high for this cycle. But again, we're that kind of forecast is so far out with Bitcoin that I don't really look and pay too much attention to that. So let's go ahead and move on. I'm going to take a look at the indexes, right? And I'm going to move to a different chart here. And I'm going to take a look at the SP 500 because that's just a good bellwether when it comes to stocks and what might be happening. We are seeing the stock market, the futures market kind of opening or pushing down a little bit prior to the open. But the targets that I drew before remain. So we have our all-time high we have to watch out for at 57.25. Above that is a target based on this impulse up, just like we did with Bitcoin. Same kind of measurement. And that impulse up has taken us to 57.96 or really 58. So I just put it kind of just below 58 because I don't like to go past those round numbers. A lot of human beings look at the round numbers significantly, even though they really don't mean anything besides the fact that they're a round number. But that's all right. Psychological stuff is important in markets. And then, of course, right up here, right at about 50, right at 6,000, just below that, 59.70 is a number I'm looking at for a Fibonacci extension. And that's just based on this impulse down here, right? We could always take a look at some higher time frame impulses and do all the same work that we did before. However, I am happy with those targets and I'll just hold on to them for now. 6,000 being a nice round number and 59.70 being below that. I do see right now basically price chopping sideways into the election because I've seen a look at the historical charts. Good morning, Diane. Thanks for coming in and joining. Justin, when you look at the indices, do you adjust for contract expirations? No, but that's a good idea. A lot of people do trade the options on the indices. With indices, I look more towards just targets. Contract expirations on a higher time frame are going to push things around. It's important to look at. Probably should look at that, but I don't really trade the indices. I should though. Indices are actually like a pretty. I'm looking at it as like basically by the dip. See, look at this chart. I mean, just this is a daily chart, right? So if you just buy every single dip, you're gonna win. Until you kind of have these pullbacks. But if you are in an uptrend and you just buy the dip, you win. I mean, indices really are kind of a no-brainer. That's why a lot of money goes into the stock market. MavBet, good morning. So what Justin's talking about is options contract expirations, and there, that's going to matter because the big money is going to make sure that their contract expirations are not going to be underwater, right? They're going to push price around to make sure that they're not losing money when their contracts expire for their futures. Let me zoom in a little bit. Apologies for not doing that earlier. It's going to be hard to see the numbers until I do that. Okay, so we got Lisa Gray. Yes, the heart monitor, of course. Quarterly expirations. Okay. Yeah, that's the same thing. Justin, that's very key. Quarterly expirations, though, they're not necessarily right at the end of the quarter. I'd actually have to look that up. But the targets are going to be the targets. So the way I look at expirations, Justin, again, that's a high level question. It's a really good question. With contract expirations, the way I look at that is I just don't trade on those days. Remember, I'm a day trader, right? I'm not buying and holding for weeks at a time. I'm buying and holding for hours at a time. So I just avoid the markets on quarterly contract expiration days. If there's going to be like a quad witch or something like that, I just don't trade that day. Just too much manipulation on days like that. I wait for those to end and I go trade those days. And that's how I handle it. I know how to trade my charts, right? Anything beyond that, like, yeah, you can look up the data and you can find out where the open interest is and all those things. But you're starting to get into territory that's a little bit hard to predict. It's hard to test that. I can't go back and test. Oh, well, I mean, I can, but it just gets like way too time consuming to go back and test. Oh, what was the open interest? Well, what happened this day? Where was the average contract expiration? Where was the mean and median? Like, it just gets into this data that's just really too deep for me to give a crap. I'd rather just avoid those like 4 or 5 days of the year, like I'll just trade after they're done, or even that week. Like the several days preceding that, it just becomes real tricky. So it's easier for me to it's kind of like it's like normally going to the gym and you're pushing just a couple plates or whatever it is, and then that 1 week for 4 weeks out of the year they add 2 more plates, and you're just like, okay, I mean, I can push this a couple of times, but am I getting any worth out of it? So and there's really not a very good way to test for that because it's so like a small sample size when it comes to testing. So my data methodology says avoid it. It's not worth the time. Simple as that. But a really good question, Justin. I mean, that's that. I'm glad that you're with us over at Algo Factory because you do bring some equities experience. Over at Algo Factory, a lot of us are kind of crypto based. And while I do have plenty of experience with equities, those are things that I don't deal with. Right. That's why I can trade equities if I want to, because I know the days to avoid them. It's like just like with Forex, for example, we have that news coming up here in an hour and 18 minutes, and I just avoid trading that. I don't try to trade that. You can't back test for that. News is going to be very, tricky, right? You don't know what the news is going to be. Flipping a coin, all your odds go out the window. It's not how I roll. I trade where I know the odds, or at least where I have a pretty darn good idea about the odds. So thank you all for joining. We're going to hop over to the private live lab. I imagine V the Girl is going to join us. I haven't heard from him yet, actually. I know we were up 1 or 2 a.m. last night talking, or at least texting on a project that we're doing. So, he might be asleep. That was really late for him because he's over on the East Coast. So he might be trying to catch up on that. But either way, September is when everything wakes up, folks. Just so you understand, like, there's that song from, I think, Green Day, Call Me When September Ends or something. Well, really, in the markets, it's Call Me When August Ends. September is just August is a dead zone for markets. There's nothing going on. We did have that whole surprise Japanese yen thing, but aside from that, everything was pretty calm. If you're in equities, it was kind of nice because you're able to just ride the manipulation upwards, which should tell you a lot about markets in general. But for now, I'm going to go ahead and end this live lab. I want you to go over to algofactory.tech. Check out our website. Go over and let me see here. Go over to algofactory.tech. We help people build their own trading method, and that's what's key. All right. It's that's an important thing, right? If you're not building your own methodology, then you're going to be in trouble because you're just going to be trading somebody else's stuff. You're not going to have any confidence in it. You need to build your own methodology, and that way you can have confidence in it. You built it yourself. You back tested it. You understand how it works. It's based on your personality. And most people in trading learn, most people in trading, they try other methodologies and they just fail because they didn't build it themselves. They didn't take the time to make it. It's a big deal. 99.9999% of people who fail in trading fail because of psychology. They have a bad week, bad month, whatever it is, and they give up, right? And they might even have a perfectly good method, but because they got stung a little bit because they just had a bad streak, they don't have any confidence in their methodology because they don't understand how accurate it is. They don't understand what their expectancy is. They don't understand anything because they've never studied it, right? So avoid all that. Come to algofactory.tech. Do not forget.
Join us or die.